different. In an uptrend, price may break below a resistance level that has turned into support after a breakout, creating the impression of a trend reversal. However, the market quickly closes back above the level, creating an internal liquidity sweep before continuing higher. In a downtrend, price may break above a support level that has turned into resistance after a breakdown, creating the impression of a bullish reversal. However, the market quickly closes back below the level, creating an internal liquidity sweep before continuing lower. The key difference is that internal liquidity is a continuation signal, while external liquidity is a reversal signal. External liquidity targets major highs and lows, and often leads to a change in direction. Internal liquidity occurs within the trend, and is often a sign that the trend is ready to continue. Look at this chart example. This is the British pound versus Japanese yen on the 1-minute time frame. As you can see, the market made an impulsive move, followed by a retracement, and then another impulsive move lower. This support level was broken during the downtrend and turned into resistance after the breakout. Now look at what happened next. The market retraced back toward the resistance level, broke above it, and then closed back below it. This is a clear internal liquidity sweep. The liquidity sweep traps buyers who entered on the breakout above resistance and triggers the stop losses of sellers who entered too early. Once the market closes back below the level, it signals that sellers are regaining control. Now let's place the trade. You enter at the close of the rejection candle. Your stop loss goes above the highest point of the liquidity sweep, and your target is the next major support level. Now look at what happened next. As you can see, the market moved lower and eventually reached the target, providing approximately a 1-to-8 risk-to-reward ratio. Trades like this appear frequently in the market. One reason they can be so powerful is that they occur in the direction of the prevailing trend. Instead of trying to predict a reversal, you are simply waiting for the market to sweep liquidity and then continue moving with the trend. Because the setup is already aligned with the downtrend, it generally has a higher probability of success than counter-trend trades. This is why trend-following liquidity sweeps are often some of the best trading opportunities you can find in the market. Now look at another chart example. Look at this chart example. This is the euro versus US dollar on the 1-minute time frame. As you can see, the market made an impulsive move downward, followed by a retracement. This support level was broken during the downtrend and turned into resistance after the breakout. Now look at what happened next. The market first broke below the support level that had turned into